Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So today I'm just going to do a very quick video on two companies that were requested by some of you. Okay, the first one we're going to look at is Merck, and then the next one is Lilly and Company. They're very similar. They're in pharmaceutical companies. They actually develop a lot of drugs. When you look at these type of companies, I'm going to focus more on the financial side of it, but you also need to look at their pipeline. The pipeline is basically the products that they have coming up in the next few years, and basically they go through phase 1, phase 2, phase 3. Phase 1, they obviously testing on number of people. Phase 2, they are basically test on a lot of people. Phase 3 is when they actually 1,000 plus people, test on 1,000 plus people, and then after that, once they're happy with everything, they send it for under review by the FDA, and then the FDA decides whether they actually approve it or not. And as you can see, they've now got Merck, for example, has got antiviral COVID. In fact, thing they got working on, they've got something for coughing and whatever. So when you look at the pipeline for these companies, what you see is if you work in this industry, it will be easier for you, okay? But when you don't understand this, it's just important to see that they've actually got a pipeline of products that they're working on. So for example, they've got HIV, one infection and all that kind of things. This company actually has a product called Keytruda, which is used for cancer. So it is good to see they've got all of these products is in the pipeline. When you look at the phase 2 as well, phase 3, you've got all of this, okay, and then you've got 3 that are under review at the moment. So it's important to look at, and each phase they will tell you what it means. So they're testing about 20 to 100 people for phase 2, phase 1, 100 and to 500, and then phase 3 you got like 1,000 to 5,000 paid patients and so on. So that's basically in a nutshell what you should be looking at. And also look at the same thing for Lilly as well. Okay, so they've got regulatory approval achieved. They haven't got any at the moment, but they've got some that are under review, some are in that phase 3, and then they've got phase 2, and then they have some that are on phase 1. So as you can see, they've got loads of different drugs, and a lot of it is for diabetes, cancer, all sorts of things. So you need to look at their pipeline, and if you understand a lot of it, then you've got really massive advantage. And this is what Warren Buffett always says: if you understand what the company does and you like the financials, that's the company for you. Okay, that's why I love the tech companies, because if I look at, for example, companies like Qualcomm, for example, when I look at their pipeline and the product, I can tell basically where they're heading. Whereas this doesn't mean a lot to me, okay? And I don't know whether they're going to go ahead on whatever, those kidney diseases and all that. Listen, you're going to have to do the research for that for yourself, for that kind of thing. But let's have a look at the details for this. Right, so the first thing we're going to look at is just the financials of the company and if they are healthy, and then we're going to look at the profitability. Then we're going to look at the valuations, whether it's actually overvalued, undervalued at the moment. So currently trading $86 per share. PE is lower than 20, which is very good for a company like this, okay? They have EPS, okay? Oh, they got free price to free cash flow here of 25. So this tells us basically based on cash flow is a little bit expensive at the moment. Based on EPS is really healthy. Market cap over $221 billion, which is great. They have a wide mode according to Morningstar. Capital allocation, they have a standard. So the capital allocation is basically how company is actually using our money and so on. So it's standard, and then there's a couple of other criteria. Annual dividend yield, okay, of over 3%, 5-year growth rate 7%, and dividend growth streak of 31 years in a row. The payout is very low, which tells us there's room for improvement. They can actually increase that this dividend if they want to. So it's already paying about 3%, so they can actually increase that. Dividend safety 99%. Why? Because they have almost $10 billion in the bank. When it comes to beta, very low, which is very good. Current ratio above 1, which is good. So that means next 12 months, the company, you don't have to worry about them. In terms of profitability, profit margins look healthy. The return on equity looks healthy. And when you look at their quarterly revenue growth, is about 24%, almost 23.5%. I couldn't find the quarterly earnings growth, but when you look at the next 5 years, the analysts are expecting this company to grow up, the earnings to grow about almost 10%. According to Simply Wall Street is actually undervalued a lot. Look at the price target. $212. Now that, for me, that's unrealistic. One of the brothers, actually one of the guys, asked me, why am I using this if I don't agree with them? It's good to know that, basically, because they use discounted cash flow model, same thing as Morningstar. So they must be a lot more bullish on these companies than Morningstar. Morningstar seems to be a lot more, they use a lot of margin of safety, I guess. So it depends. But again, their numbers are not necessarily wrong, but maybe they're a little bit more bullish and they actually think the company will do better than Morningstar and so on. So I like it, and I want to basically keep it in there. So Morningstar thinks it's fairly valued at the moment. It's $94 per share. And when you look at this, okay, there's not a lot. For me, I would just say, if I was starting a new position, I will definitely wait this stock to go down, maybe up to, I don't know, 73, 75-ish. I've seen it there. I've seen it lower than that. Okay, I've owned this stock for about quite some time now. So I've seen it lower than that, absolutely. And then target price of 94. Tip rank thinks is about 7% upside, and there's about 93%. For me, it's a moderate buy right now. But if you start in a new position, maybe wait until it drops below 70. It can happen, okay? And if that happens, then maybe that's a good time to purchase, okay? That's it. Again, I'm not a financial advisor, but I'm just saying that's probably a good thing to do. So I think for me right now is a moderate buy. Okay, so the next one we're looking at is Lilly and Company. Again, like I said earlier, they do similar sort of drugs. Currently trading $301 per share. PE show, when you look at the PE, when you look at the price to free cash flow, it's definitely overvalued. Definitely overvalued, in my opinion. EPS $6, market cap of 296. So it's slightly bigger than Merck. Economic mode of wide. They have basically capital allocation exemplary. Annual dividend yield of just 1%, above 1%, 5-year growth rate about 11%, so they're growing it a lot faster than Merck is. Dividend growth streak of 31 years, 42% payout ratio. So that tells us there's room for improvement when it comes to that. Also, dividend safety 96%, and they have $5.3 billion in the bank right now. Free cash flow beta is quite low, current ratio is excellent. Profit margin and return on equity are really good. Again, same thing here. A quarterly revenue growth of about 7.5%. Quarterly earnings growth last year it dropped quite a bit, and that is the reason I think this stock went down quite a bit, because at one point this stock was really overvalued. So maybe that's one of the reasons it went down a little bit. Next 5 years, the analysts are expecting this stock to grow about 6.4%. Simply Wall Street thing says 31% undervalued at the moment. Price target of $440, currently trading $301. 28% premium according to Morningstar. Price should be about 235. Okay, maybe a bit more margin of safety there. Tip rank basically is almost a flat. $303. Right now it's $301, so it's probably kind of fair value or whatever. For me, if I own this stock, I don't own it, but if I had it, it will be just hold and leave it, because it's a quality company. Okay, but if you're thinking of starting a new position, you might need to wait. You might need to wait at least maybe this to drop about 250-ish, and I'm sure it can go down that low. Let me quickly check. So looking at this year to date, let's see, the lowest it's been is $190 per share, and that was April, this time late April, basically April of 2021. Okay, 20th of April basically was $990. So it can happen. Okay, and if it goes down to that, that would be brilliant. Okay, but as you can see, it went up as high as $311, and from there it's about 3% down from its high. So that is not actually great. Okay, so when you look at the 52-week high was $314, and then lows was $178 per share. So yeah, the PE is quite high. The stock itself as a company is great, but I think if you don't own it, maybe just wait. If you own it, just hold it, or maybe take some profit off the table and just see if there's other companies. But I think definitely Merck as well. It's probably Merck's better option for me right now. But again, like I said, for me, it's a moderate buy. It's not a straight buy. I probably would like in that mid-70s if I'm being honest with you. okay, because I think I'm a little bit up. I don't know how much I'm actually up. Okay, £253 or 16% up. At one point I was down 10%, 15% of this stock. I kind of completely forgot about it. I haven't bought any lately, but hey, it's actually doing well, better than I expected, to be honest with you, because at one point I thought, what on earth is going on? But when you look at their pipeline, when you look at their product lines and the Keytruda, they actually make a lot of their revenue actually comes from that Keytruda. So if the patent runs out in the next 5 years or whatever, then I'm sure the stock will go down a lot more. Because remember, when the patent runs out, then that gives the other companies, like for example Lilly, whatever, to actually start producing the same drug. And I don't know how long of that drug is left, so maybe that's something you need to look into. And that's the kind of thing you need to look into when you're talking about pharmaceutical companies, because they do have these patents run out every couple of 10, 20 years. When it runs out, then that means it gives companies like Pfizer, who's got a lot more money, a lot more power, to actually start producing the same product. And then Merck has to then kind of reinvent. That's why they have this pipeline. That's why they come up with these pipelines or products. So at least one of these products will be a hit, and then they will have the patent for another 15, 20 years. Right, so that is in a nutshell the two companies that I wanted to talk about today. I hope you enjoyed the video. If you can't enjoy this kind of content, please give the videos a like. That's all I ask. Thank you very much. Assalamu Alaikum.